Let's get another check on our top story of the night. Walmart shares plunging. They're down 9.5% right now. The big box retailer cutting its quarterly and full year guidance, citing inflation pressures and dollar headwinds. Walmart seeing shoppers spending more on things like food and less on higher margin items like clothing and electronics. And inflation is just one of the major reports Wall Street is bracing for this week. The list also includes Wednesday's Fed decision and second quarter GDP on Thursday. It's been a witch's brew that could set the direction for interest rates. Let's bring in Megan Swiber, U.S. rate strategist at BofA Global Research. She's also a former New York Fed senior analyst. Great to have you with us.
Thank you so much for having me.
You think 75 basis points is in the cards and the Fed's going to become less hawkish? Why?
Yeah, I think that's the story here. I think 75 basis points is pretty much a done deal. If the Fed wanted to do 100 basis points, they probably would have signaled that before the blackout period. But communication going in really very much so endorsed the fact they're only going to be doing 75 basis points. And I say only with a little bit of a grin because it is still such a huge rate hike as they're still on this race to get rates back to neutral.
Why would they become less hawkish, though? I mean, we just heard from Walmart. We were telling the viewers again about this, the story. You know, consumers are feeling deeply the impact on inflation. Those pressures are still there. The Fed's fight is not near over at this point. So why indicate that they're less hawkish?
I mean, that's such a good point here, too. But inflation is this double-edged sword, right? On one hand, the Fed really needs to get moving, continue to raise rates above that neutral rate to curb growth, curb growth and also curb inflation. But on the other hand, inflation is already doing some of this work in terms of slowing growth and slowing demand for them. So the Fed has to be pretty mindful here as they get rates already pretty close to that neutral rate, how much further they want to go from here, because this does, of course, risk sending the U.S. economy into a recession.
Hey, Megan, it's Tim Seymour. Thank you for joining us. I guess my question is on that neutral rate and how much they have to exceed really expectations to get through some of the psychological findings that we're all learning about inflation and really where the Fed has acted in the past.
Yeah, I mean, it's honestly the question that's top of mind to every bond investor right now. In our view, we think the Fed's probably going to top out between 3.25%, 3.5%, which will happen by December this year. And we think that as they approach this neutral range, which the Fed, to be frank, honestly doesn't know what neutral necessarily represents themselves, they think of that as that range between 2.5%, 3%. But as they're creeping towards that, and will probably do once they hike 75 basis points this week, they need to be a little bit more mindful of what they're doing to the economy because they're already applying that needed pressure to slow growth. I mean, just look at the housing market, right? With mortgage rates at 6%, that's already doing a lot of the work that we need to see to slow demand. And financial conditions have tightened pretty materially over the past few months, with the Fed just guiding the market to needing to get above neutral.
Your commentary about what you think the average person is going to do in terms of pulling out money from the stock market, putting it into sort of the safer areas like even cash. Why do you, I mean, savings rates still haven't gone much higher. If you take a look at savings rates in New York, even at Bank of America in New York City, I mean, it's like 0.01%. So what is it such a fear about equities markets at this point that's going to grip consumers and investors?
Yeah, I mean, it's a good question. And this is the portfolio balance effect. This is how the Fed actually implements monetary policy, right? By raising rates that pulls investors into more safe haven assets. And as you mentioned, the front end probably is not seeing this, impact quite yet. But as the Fed moves rates higher, certainly closer to that 3.5% threshold, we are going to see interest rates that they're going to be earning on very liquid cash savings will increase. And that will pull people down the risk spectrum into more risk-free assets. I mean, while you may not be getting a very high interest rate on the very front end, on very front end cash, we have seen 10-year rates really move very notably higher, really over the past year. And this is doing its job to help slow the economy, slow growth, and really kind of pull investors down that risk spectrum away from risky assets. And this is what the Fed needs to see happen to do its job. This is what they need to see happen in order to cool that demand and, of course, cool that inflation.
All right, Megan, great to speak with you. Thanks for your time.
Thanks so much for having me.
Megan Swiber of Bank of America. All right, Dan, I was going to say, what do you think the Fed should do? Actually, I'm not sure. I thought I knew the answer to that before asking you in terms of what you would say, but now I'm not sure.
Yeah, I mean, listen, I actually agree with a lot of what you just said. I mean, I think the Fed should kind of hit it hard. They have to if they surprise to the downside 50 basis points. I don't think that'll be great for equities, to be very frank with you, but I do think that they've already set the course in action for quantitative tightening, so they're not going to change that. Might they kind of leave the door open a little bit? We know they're going to have Jackson Hole at the end of next month and then this September meeting. And might there be a pivot if the data gets increasingly weak, if we start seeing worse housing data, if we start seeing the stock market kind of retest those lows from June, if we start seeing unemployment tick up? Yeah, they will. But I don't think they're going to make huge changes to QT, because that would really be, I think, a problem. They need to kind of follow through with what they said they're going to do on rates and then the balance sheet, and then really be data dependent. So again, I don't think that we're going to get a lot of clear-cut answers this week, but I do think that S&P 500 is probably going to be retesting those prior lows, not because of what the Fed's doing, more because the economy is weakening quicker than some investors think, and down 17% on the year, I just don't think is enough to encapsulate everything that's going on with this economy and is likely to go on between now and the balance of the year.
Guy, we all know where you stand on the Fed and the job it has done so far. So if you had the opportunity to raise your hand and ask Mr. Powell a question, what would that question be?
Mr. Powell, Chairman Powell, respectfully, for years you were looking for, almost begging for higher inflation. Well, you got it. I understand that you can be wrong, but what made any of you think that you could somehow control what you were begging for all along? The hubris associated with that is problematic. It's okay to be wrong. It's not okay to be arrogant. What are your thoughts, Chair Powell?